So this is the second to last week of the 12-week Bitcoin mining education series. And we've covered a ton of topics, Meltem. So we've covered economics, we've covered tools, we've covered our favorite homeboy WIC, we covered primary and secondary ASIC sourcing. And a lot of the, a lot of questions still exist about investing in Bitcoin and Bitcoin mining, right? So I thought we could have a very open conversation today about what we're seeing, and very similar to the conversation we had on Friday night over espresso martinis about how we think about investing in mining. So, I think if we want to start, we can talk about like mining as a whole, right? And how I look at it is there's really like two different areas that investors can start to look at. There's infrastructure investing in mining, right? And we think about a traditional Bitcoin company. And then there's also like hardware and debt side. So there's equity and debt. On the infrastructure side, from a VC perspective, right, which you are a very good VC, you have like over 250 companies that you've invested in at this point, which is incredible.
But I'm going to make a distinction. I'm not a venture capitalist. I'm a vibe capitalist, which is a very important
vibe capitalist. I'm into that. From a vibe capitalist or a venture capitalist perspective, traditional like investments in Bitcoin mining companies were kind of difficult, right? Because it has large upfront capital commitments without that like 20x return that you're always looking for. So I think that the narratives have shifted since when Bitcoin mining first came out, but would be really curious about your thoughts on the infrastructure side.
Yeah. Yeah, the way I think about it, and again, the perspective from which I come at investing, my background, I started my career in the oil and gas industry. And specifically, I started at the time when the onshore US oil and gas industry was getting started. What I focused on, and my background was in math and econ, but what I focused on was the financialization of onshore infrastructure. Starting with the upstream side, so E&P, so buying land rights and mineral rights, equipment leasing, rigs, crew management, supplies, so pipe and all of the other infrastructure components that go into E&P, financializing that, financing that, then midstream, so pipelines, gathering and processing. I spent a lot of time working on pipeline MLPs, which were new construction for how people were financing infrastructure in these new onshore resource plays. And then later in my career, I spent a lot of time on the downstream side, which is refining. So taking the petrochemicals that are produced, transforming them into other products, right? Like 95% of the things in our world today contain a petrochemical of some kind. So the refining process, but then also looking at the utility space and that whole part of power generation. So that experience informed a lot of my perspective as to how I approach the Bitcoin value chain. And when I think about investing in mining, right, there are a few different ways you can approach the mining sector. There's hardware, right, which is a whole world of its own, and semiconductors are a highly specialized field of investment. There's actual mining infrastructure. And when we say infrastructure, this is a word that crypto people and like VCs love to overuse without any specificity as to what it means. But I think when we talk about mining infrastructure, and when you and I use that word, what we are talking about is facilities, right? So people building an actual physical warehouse, typically you need to co-locate it next to a power source. So you need to have your own substation. You need to convert the power you're getting from the grid into the right voltage to power your mining operation, and then operating that facility, right? That's infrastructure. So there's that component. And then there's a whole ancillary set of products and applications. That's where we see like mine financing businesses of different kinds, marketplaces, hosting providers, technology vendors who provide energy management services, technology vendors who provide mining management and mining optimization technology pools. Like there is a whole range of verticals that are being built on top of mining that are just very different from like like the hardcore infrastructure investing side. And so I think, again, when we look at the world of mining, historically, the way that people in the crypto space have treated mining and thought about mining is through this very like unilateral old school mindset, which is I am buying machines, I'm plugging them into a facility and I'm running those machines. And that is mining infrastructure. That is how you invest in mining. And I think that concept is completely antiquated because there's now an entirely new mining infrastructure stack that's being built that includes technology, that includes hardware, software, and all of these different layers that appeal to very different investors. So I think when you and I wanted to sort of lay out the different investment components of the mining landscape, I wanted to start on sort of hard infrastructure and the types of investors who are doing infrastructure investing, and then migrate all the way through the stack to the non-hardware component, which is the technology and the financing businesses, which have very different returns from the underlying like physical mining businesses themselves. So how do you want to run through that stack, or do you want to like react to what I just said?
Yeah, so I think that makes a lot of sense. And I do think that we're entering like a new phase of investing in mining where it isn't just that like, plug in a machine, right? And that's like the only thing you can invest in mining is like someone who builds out infrastructure. So I think that is very, very true. We are seeing also like more and more traditional investors get into just the mining space, right? And they're doing it through different ways. So for example, a company that you had invested in, Veridi, right? Like they're creating a new type of product for people to invest in mining. And we also saw that BlackRock, which is the world's largest asset manager, and investing now in like Bitcoin public mining companies, right? So I think that we're getting to like a next stage of investing. So let's start with, I guess, infrastructure, right? And let's talk about, we talked a little bit about how, investors are looking at that. And then we can go into all of the other services, right? Like the financialization of mining. I think, the hardware side is really interesting and what companies are doing there. So do you have anything else to say on the infrastructure side?
Well, I want to start, let's talk about hardware briefly, right? Because I think, again, what I love about the mining series is I think the concept that people have of mining is very antiquated and based on a view of the world that's like no longer tethered to any form of objective reality. So if we look at the hardware side, historically, Bitcoin hardware has been dominated by Bitcoin native hardware players, right? They've typically been the parties that produce ASICs. And I think we're going through a really interesting phase in ASIC production because, as you know, the production, the demand for ASICs is outpacing the supply of ASICs. And this is true commonly across the entire semiconductor space, right? Actually, in the automotive space, we saw Volvo just announce they're cutting production by 40% because they no longer can source the semiconductor components that are needed. One small island, right, whose sovereignty is contested, produces 75% of the world's semiconductors. So like severe issues there. There's actually really interesting innovation happening on the hardware side, right? There's innovation in terms of how energy efficient you can get the chips, right? Which is measured typically by sort of how big the chips are. Like right now, there's some people claiming to work on 5 nanometer chips. The theoretical limit of chips is 2 nanometers, right? Because the width of an electron is 2 nanometers. So below 2 nanometers, there are questions around like electron interference and how the actual circuits, will work. But I think there's actually innovation happening outside of just the core wafer itself. So if we look at interconnects, right? Interconnects have historically been made out of copper. There are a bunch of companies that are working on using graphene instead of copper, which will improve conductivity on the ASIC and make it much more energy efficient. I've actually been looking at investing in a number of companies that are in that space and making not just the core ASIC design itself more efficient, but changing out some of the tooling and some of the components on the ASIC itself to recondition older ASICs. So there's a real cool company in Austin called Lab 91 that's working on the graphene interconnect component. And I think, again, there will be a few companies that get built in this space that are really, really valuable, that own really valuable intellectual property. So I don't think that the hardware sector has been considered by investors. I think most people dismiss it outright because the cost of building, competitive chip IP sort of footprint and then getting it into production has been really challenging. But I think there's a lot of room for innovation on the hardware side. And I'm excited to see more investors who have the appetite for that type of risk and reward participating there.
Yeah, totally. It's kind of funny because on the hardware side of things, I think that's where, traditional investors feel more comfortable providing debt, against hardware versus infrastructure. So it's, it does require a lot of, I'd say, like, knowledge and understanding operations to be able to back someone on hardware side. So like Galaxy does this, right? Like, we provide miner finance tools for miners. And on the hardware side, I think that, there's other people doing it too, right? There's Galaxy, there's Foundry, there's NIDIG, there's Celsius. And I think that it's helped miners be able to get to like the next step, right? To use what they have as assets for debt to then be able to draw down on more capital. I think that has been net good overall for miners, and it's a way for investors also to dip their feet into mining and understand it, and then maybe they'll also add onto the value chain. The one I think it's kind of funny, and this is just like a side story, but like, if you are asking investors for money in mining, and especially on the hardware side, like, it does take a lot of diligence, right? You have to feel very confident in what you're giving people money for on the hardware side. So you have to know their operations. So the thing that always gets me and is like a red flag is when someone emails me and says, hey, I want to buy these machines. I need $10 million and I need it within 2 days. It's like a very different, it's not like a traditional like loan where you go to and you could draw down on. It requires us, it's kind of a little bit of like a relationship, right? Where you have to get into bed with someone and feel comfortable with what they're doing for 18 months plus. So I think that, on the hardware side, it's definitely evolving. We're seeing more people come, and I think that we'll see more traditional investors.
And I think, again, right, like IP portfolios, especially in the semiconductor space, and I'm not even talking about physical machines yet, right? I'm talking about IP portfolios. Like, IP portfolios in the semiconductor space are incredibly valuable. I do think they've been ignored by investors because hardware investing is very niche and it's highly specialized. Like, I'm not a theoretical physicist and I don't have the competence to do due diligence, right? Like a really theoretical, like graphene interconnect investment, but I work with investors who do have that capacity. I think very specialized. I think that area will continue to grow. And I think ASIC related IP portfolios, not just related to the ASIC itself, but all the tooling around the ASIC and improving efficiency will become very important, because we have to remember on the Bitcoin network, right? No matter how efficient you are, you will never be able to produce more Bitcoin than the block reward. And so the verticals along which people can optimize are hardware efficiency, business efficiency, like financial engineering, right? And financial efficiency. And we'll get into the MiFi side. And then the last one is energy efficiency, right? Like their cost of the raw inputs. So the ASIC and the electricity are the two raw inputs. You can optimize those, or you can optimize the financial engineering of your business. But like, that's it. There's no other way to produce more Bitcoin. The only thing you can do is optimize how much Bitcoin you produce and control the cost at which you produce it. Those are the only levers, which in a way make Bitcoin really simple, like oil and gas, right? Like in oil and gas, I only had two inputs I really cared about. I cared about the cost at which I got oil from the wellhead to the refinery, right, which was my sales point. And I cared about the cost at which, the price at which I could sell my oil, right, which was typically done through a trading desk, right? And commodities now, like the paper market for commodities, synthetic commodities, is way bigger than the actual underlying spot market. And I think a similar thing will happen in Bitcoin mining. But anyway, so here we are on the hardware side. So there's a lot of IP innovation, and there's the machines themselves. The machines themselves are fairly straightforward. And to your point, I think more traditional semiconductor manufacturers will start to get into producing ASICs as it becomes more lucrative. And then I think from an investing perspective, right, manufacturing in hardware is typically like a private equity type of play. And then it's a public markets play, right? Like you need access to really significant amounts of capital to do production runs. And typically that's reserved for publicly listed companies, which is why we've seen, Bitmain and a number of other ASIC producers going through the process of going public. On the flip side, there's a huge component of financial engineering on the hardware procurement side. This is what you do a lot of, right, is MiFi, or mine finance, as we like to call it. And I think this is particularly well suited to existing private equity investors who are looking for ways to utilize cash to obtain a steady like return. In a way, I also think it's really interesting for cash flow investors, right? Because ASIC leasing is a business model that produces a great cash flow stream of anywhere from 12 to 18% annualized. So for people who have cash who are looking to put it to work in the market, I think at Fortress, right, their internal hurdle rate is 15% for the way to deploy their cash. And that's very achievable today in MiFi. I don't know if you want to comment on that. You're much closer to it than I am.
Yeah, I think that I kind of said what I wanted to say before, that I think that there's like, you know, a lot more people joining like the races on miner finance, which is net good for Bitcoin miners because it will become more competitive. But it is still like, I think the most important thing for us, like when we're looking at miners, is that diligence factor, right? And right now we're seeing, you know, miner finance. It's a way that miners can get access to capital that they need now with existing assets, right? But I think that is because that's traditionally been really difficult for miners to raise money on the infrastructure side. So they like use their assets that they have as leverage to be able to continue to grow. So I think that miner finance will continue to be like a tool that miners use in terms of on the hardware side. And then I think financialization of mining will come in many different forms beyond just the hardware side.
Yeah, absolutely. I think that's 100% true. So if we move from hardware, right, sort of starting at the most basic building blocks, right? So we move from the hardware side into the next step, which is I'm going to take my hardware and plug it in somewhere. So if we look at what's happening on the infrastructure side, if we look at facilities themselves, I think there's also another common misperception. When people look at publicly listed miners in North America, I think most people don't recognize that 70% of North American mining is done through a hosted facility, where miners, the publicly listed miners themselves, are not building and operating and managing their own facilities. They're effectively shells that are financing companies, right, to a certain degree, where they finance the ASICs, they then put the ASICs in a facility that's managed by a third party, and they just manage, right, the margin between the cost of securing the ASIC and hosting it and the Bitcoin output that they're getting. So effectively, I think what people don't recognize is a lot of publicly listed miners, to a certain degree, not all of them, and their operating models vary greatly, but many publicly listed miners, particularly these newer ones going to market through SPACs and reverse IPOs, they're just like trash financing companies, no offense, but like there is zero actual business in those companies. They're shell companies that are doing a financing arbitrage between the output of Bitcoin and then the cost of them producing that Bitcoin, all through third parties with equipment that they don't even own, which I think is pretty interesting. That's an attractive model for some people, but I think, again, when people think about mining, that's not really what people think they're buying. That's 100% what you're buying. And I think one of the things people don't recognize is, and we've experienced this with Compass, right? Like if you don't own your own infrastructure and your own facilities, you are at the mercy of the market, right? And pricing in the market moves dramatically right now. No one can get any hosting in the United States. Like capacity is severely constrained on the hosting side. Capacity is severely constrained on the ASIC side. Like if you don't control your supply chain and your operations and your infrastructure, it's very difficult to long-term preserve that margin that's been created through financial engineering.
And I think that's what we saw a lot of the public companies doing last year with ASICs, right? Like they said, okay, we're announcing that we're buying all of these ASICs out till, you know, 2100, right? And unfortunately, that has become a metric that has allowed people to value those companies when really the value should be on like what they have up and running now and their underlying operation, right? So I think you know, there's definitely some overvalued public mining companies, and then I think there's also some undervalued public mining companies. But the difference is everyone buckets Bitcoin mining and Bitcoin public mining companies into one bucket without looking, you know, a couple steps deeper to see how they are differentiated. And one major differentiator is on if they own their own infrastructure or not, or what their plan is for the future. Because like you said, you can have a strategic relationship with a co-location facility, but that can change very quickly. And so that's the really hard part. And I think what else we're seeing is as Bitcoin price increases, and we saw this in 2017 too, right? More people are like, hey, mining might be really cool to get into, but there is like a lot of knowledge gaps, right? And there is no traditional like learning method for you to understand how Bitcoin mining works. So if you are starting up a new operation, you're like, hey, I'm going to go public via SPAC or some, you know, weird type of triple reverse merger thing that I still can't figure out how those things really happen. You're like, okay, bot machines, they're coming in September. You don't realize that if you've never ordered machines before, they're probably not coming in September, right? So you have to build all of those factors and risk factors into what you're building. I was reading about gold mining, right? And and this kind of made me think about how, as you know, the market changes, more miners get into it, and it is difficult to differentiate between what's real and what's not as an investor. And there was a Forbes story in 2006 that warned investors to watch out for promoters who were pushing like iffy like gold mining companies. And I feel like that's very like similar to what we see sometimes today. But I think there are also a lot of really great people building in Bitcoin mining. So it's been like really fun to watch that whole market evolve over the course of the last like 4 years for me specifically.
Yeah, and I think again, as we look at the infrastructure side, building out facilities is very much a traditional real estate play. So I think the types of investors, again, just taking this back to investors, right? The types of investors who are attracted to the idea of building out physical infrastructure, a data center, right? Are traditional data center and commercial real estate investors. And we're actually starting to see a lot more interest from the CRE side, the commercial real estate side, people who are used to sort of like 12 to 24 month development cycles where they're investing large amounts of capital. And what we're seeing people doing is contracting capacity up front, which I think is pretty interesting to sort of secure cash flows and rent streams from leasing out that space. But here, I think, again, a great example of what might happen to the mining space on the infrastructure side is what happened to data centers, right? Equinix was one of the first companies that started building data centers for co-hosting and for outsourced hosting in the early days of internet peering and routing. And what they eventually evolved into is a publicly listed $70 billion data center REIT, effectively. And again, I see a definite blueprint here for that side of the business starting to grow. But again, to me, that's more of a real estate investing play. I'm not an expert in REITs and all of the implied tax benefits. I know people are looking at setting up data centers and opportunity zones, taking advantage of some of the tax benefits of establishing them in a REIT structure, which allows you to fractionalize ownership and then pass through some of the tax write-off incentives. But I think that's a whole investing category that's super underdeveloped. But like the CRE people are coming, they're excited about Bitcoin mining infrastructure and data centers and facilities. The second component that's really interesting is, as I alluded to, we think data centers themselves are evolving. Co-location with an energy source is becoming more popular, and in Bitcoin in particular, I think a lot of facilities are looking to co-locate with renewable energy facilities in order to further support this push towards making the Bitcoin network, less dependent on carbon-intensive fuel sources. So there we're seeing containerized mining emerging. And again, like to me, that's more of a traditional private equity model. It's CapEx intensive, and OpEx leverage comes through your ability to control your weighted average cost of capital. So to me, it's not so much a VC business, but more of like a PE model, leverage driven model, or commercial real estate model where you're gathering capital from a lot of investors, spending a lot of capital to build the facility, contracting it out at the same time, and then launching with all of your tenants in place effectively.
Yeah, and I do think that there will be a continuation of an integration of the energy sector in the Bitcoin sector. And I think like large energy companies may become like one of the largest investors in the Bitcoin mining sector because they have all this excess energy that they can use Bitcoin mining as an alternative like resource and an alternative way to gain more capital in Bitcoin. And whether they keep that in Bitcoin or not, right? I think there's going to be a wide range of investors on the energy side. Some people will want to be long Bitcoin, like traditional Bitcoin miners. I think some don't. I think some will just want that revenue stream to be able to then transform it into cash. So I think we'll see a lot more integration into energy and Bitcoin. And we're already, we're seeing that happen. A lot of energy companies reaching out to learn about this space. And I think that will continue.
Absolutely. And I think, again, having background in energy and just understanding the complexity of a centrally planned energy grid, right? If we look at a lot of the inefficiencies in the US energy grid, it's a result of, I think to a certain degree, to build a large energy plant, like a large electrical plant, it requires a certain size population, it requires a certain level of demand for you to be able to make that a viable investment. And so when we look at regions of the world that are not as population dense, right, as the United States, one of the big challenges, is how do we electrify a part of the world where the population density is just not adequate to support the economics of centrally planned energy grid? That's where I think some of these models where you co-locate renewable energy or small scale power generation with Bitcoin mining to offset the cost is really powerful. And so I think there's actually some really cool models there for the nonprofit space as well. And I've been working with and speaking with some nonprofits and some governments in smaller nation states that are very interested in building more resilient, decentralized energy grids where you can have small scale energy production coupled with Bitcoin mining or another type of specialized compute, right, where you can charge higher prices, and bringing that together in order to create sort of a self-sustaining, financially sort of independent micro grid, which I think is a pretty cool model. And again, bringing NGOs into the equation, I think is really interesting as well, because it creates a really interesting model for how we fund and finance these things. And then we can also get into like green bonds and different ways to use public debt to finance these things. So that's what's happening on the infrastructure side. Then we get into sort of the technology side, which is where I invest as a vibe capitalist. I'm focused on investing in businesses that have very low CapEx requirements, where the primary value comes from the IP and the technology itself. Now, there are consumer models and enterprise models. When we talk about enterprise models, and maybe we'll start there, because enterprise SaaS investing obviously has been incredibly lucrative. The ROI on enterprise SaaS investing over the last 2 decades, has far outpaced growth in public markets. If we look at companies like Snowflake, recently IPO'd, one of the biggest IPOs. That was a company that, started 7 or 8 years ago. If we look at companies, that are in just the enterprise SaaS space in general, has been a super high growth area. And I see the same potential in the mining space. Here, there are companies that are focused on a variety of different things, from energy management and facility operation through to network orchestration. I think network orchestration is an important component. So if I have all of these, like micro grid sort of Bitcoin miners, how do I optimize operations? Like, what is the tooling I use to coordinate activity, even switching, right? Like some miners are switching between protocols to mining, to optimize mining profitability. Like that's a whole business in and of itself. And then you start to get into some really interesting business models that are perhaps a bit more controversial, but pay for priority, right? Like block ordering is something that some companies are looking at. So there are a lot of different layers at which you can start to embed like preferential treatment of transactions on the willingness to pay. And like Bitcoin is already a fee market, right? But you can take that even further by introducing more dynamic pricing models for block space. So I think that's a whole.
Also, that still is like totally in the rules of the Bitcoin protocol.
100%.
As controversial as it is, right? It is like I think that's the beauty of Bitcoin, is it is this like pure competition. And if you want to pay more, you technically could.
And we've already seen that with Ethereum, right? With MEV, which is like value extraction on the transaction ordering side. And that's been built into a bot and is now open source, and people are constantly finding new ways to exploit, flaws in how people are structuring and ordering blocks. But the same things are happening in Bitcoin. And again, the ways that people commercialize that will differ, but you could effectively start to see someone building a marketplace for transaction ordering pricing, and that is a very attractive business model. So again, like I'm always looking for places where there's interesting leverage that can be obtained through technical innovation. And again, we can never produce more Bitcoin. We can only optimize how we engineer around the constraints of the Bitcoin network. The other area I think is really interesting from an enterprise perspective is markets around compute. And this is kind of a gigabrain idea, but I'll throw it out there. We've never really had global markets for pricing compute. But as we've been talking about, fees on the Bitcoin network and Bitcoin block reward are effectively a market for compute on the Bitcoin network. And the Bitcoin network is the most secure compute in our world today, right? Like the Bitcoin network is highly secure. Proof of work is what provides the network its security and its integrity. And so I think there is a market to be built around Bitcoin compute. Hash rate derivatives were sort of an early iteration. I don't know how attractive hash rate derivatives are necessarily, difficulty swaps, but like there's a whole lot of financial engineering that can be done here. And again, what I go back to is in the energy industry. Like when I started working in the energy industry, most oil and gas super majors did not yet have dedicated trading floors. And now 10 years later, every oil and gas firm has a dedicated prop trading desk where they're not just hedging their own production, but they're actually trading for profit in the market because they have strategic advantages. And I see similar things happening in the Bitcoin mining space, and someone somewhere will build the most amazing marketplace for buying and selling derivatives of Bitcoin compute. And I want to invest in it, right? That's a huge opportunity, huge market.
I also agree with you. I think hash rate derivatives will be the way that Bitcoin miners will hedge their future. I don't know if necessarily Bitcoin price derivatives will be the way. I think it will be on compute.
And that again, right, we're experimenting now with different product constructions. Like some of the product constructions that have been rolled out are very experimental in nature. And a lot of it's, trying to find a seller and a buyer, matching them together, and then seeing what happens as the contract approaches expiry. Because again, there isn't, a fixed data feed. There's still a lot of ambiguity. There aren't effective data oracles really yet, or globally accepted data oracles. So there's a lot of underlying tooling and infrastructure that's also highly investable, right? Is like, what's your immutable data oracle that you're going to utilize that predicates what the settlement of this contract will be? That's a business, right? There needs thousands of opportunities.
There also does need to be a third party that does this, right? Like it can't be the person selling or buying, because if I sell you my hash rate, if I'm like, Meltem, do you want, 65 petahash over the course of the next 2 weeks? What if I shut it off? Like, who's responsible for paying you, right? So I think that there is like, we've seen some people come out with derivatives, right? Hash rate derivatives specifically. I think that we need to see like 3 or 4 more iterations before it's something that completely catches on.
And I think it's still bilateral, right? And it's still DVP and like very much OTC driven, negotiated bilaterally. So I think turning it into a marketplace, making it like decentralized, fully distributed, and then finding ways to establish and sort of establish how settlement will work, right? And what conditions trigger settlement is really important. And then within that, right? So if we take price discovery and execution, open that up so it's no longer just bilaterally negotiated, and we resolve some of the challenges around settlement, there's also a whole clearing and margining layer, right? How do you margin your position? So if I have a net long hash position and a net short hash position, I could effectively build a whole desk around arbing hash, right? Or arbing difficulty across different geo regions. So again, to me, like as a nerd who likes to invest in market structure, that's a great business I want to invest in. That's a whole desk I could set up at CoinShares to trade just that arb.
Yep. And I think the really interesting thing, right, if we think about the evolution of mining, is like where pools sit. So pools were able to make that like 2% fee up until this point. But now, miners are big enough that they could basically make their own white label pool really quickly or pay someone else to do it. And I think the really interesting part about pools is that's where all the hash rate goes. So it's the natural place for the hash rate marketplace to exist. And we're seeing companies, right, like Slush Pool and Luxor look into this. And that I think will be the next phase of, the pool infrastructure, because I think pools eventually will go to a 0% fee and be like an added like bonus, because pools will make money off of the hash rate marketplace versus the actual.
And I think the pool is like the natural marketplace, right? Again, but from there, I think it will evolve. And I do think we'll see specialist firms spinning up like Alchemix, right? That was recently started, that's focused on building a derivatives marketplace, like a compute marketplace on chain. And I think, again, because the market is so large and there are so many different types of participants, there are opportunities to build this for different segments. So there's purely speculative segment that's oriented towards traders and people who want to trade like a delta neutral arbitrage strategy. There's businesses that will get built that are oriented towards miners and MiFi companies who are looking to hedge and looking to de-risk. And there's a whole de-risking book that can be built. And then there are consumers and retail people, right, who may want exposure to mining, but don't have the ability to buy a miner. So they can gamble effectively on like what will happen in the Bitcoin network through these derivatives or speculate on it. So again, I think not only are there all these different layers at which these businesses can get built, but they can also be built to address different segments of the market. And this, in my view, is like such a great fit for VCs and investors who are investing in early stage equity, because the upside is really high. And once we build it in Bitcoin as well, it can also be ported to dozens of other protocols. There are now over 10 protocols that have market caps exceeding $10 billion, right? So I think, again, as the crypto space grows, these models can also be transported across other chains. Then the last thing I just want to talk about that I think is really interesting is the consumerization of Bitcoin mining. And I think this is one, for a long time, the narrative around Bitcoin mining has been, it's not profitable for you to do as a retail user, leave it to the professional miners, like you can't compete, forget about it.
And a lot of that trickled down from the ASICs, right? Because you had to buy massive amounts of ASICs in order to like even be a customer of Bitmain or MicroBT.
And then on top of that, right, like the cost of power at your house, right? I'm paying 12 cents per kilowatt hour. Like that's not going to work.
And like, if we think about what the median cost curve is that we're seeing, we probably think it's between 3 and 5 cents per kilowatt hour, just for reference, right? So how would someone ever be an individual miner that was competitive? And maybe, I talked to someone last week, which was fascinating. He told me he didn't care about losing fiat because he would plug it into his house and just make Bitcoin. And I was like, I love that for you. And then I obviously told him about Compass because he could make even more Bitcoin through Compass because they've set up something really cool from the consumer market.
And that's where, again, I think the ability for people to buy machines, right, and to buy them in bulk and to buy them with certainty from a verified, trusted source who knows the supply side of ASICs, to be able to then co-locate that miner or host that miner in a trusted facility with low power costs. To be able to insure that miner, right? There's now businesses springing up around insuring miners and repairing them and replacing them, which I think is hugely lucrative. To then actually being able to, like, I think the next step in this evolution is fractionalizing ownership of a miner and making it accessible to a larger group of users, because buying a miner for $7,000 or $9,000, hosting it for, a couple $100 a month, and not accessible for everyone. How do you fractionalize it? Could you potentially create financial products that allow retail users to buy a pro rata share of ownership in a mining operation and earn Bitcoin? All of these things I think are really compelling. And then around that, again, you start to see the emergence of like a marketplace that has a huge GMV, like just a massive GMV. And again, I think when people look at mining, I don't understand how people's creativity and imagination is so limited. When they look at mining, it's like you say Bitcoin mining and people's brains go into caveman mode.
Yeah.
Is Logan misbehaving?
No, I was saying people say no.
Everyone's like, I thought it was Amanda's dog. He's a good boy. So I think, for some reason, like people can be really creative when they look at other sectors of the Bitcoin space. For some reason, when it comes to mining, people have zero intellectual creativity, and it's mind-boggling to me. And as a result, I think Bitcoin mining, from an innovation perspective, right? Not from a pure infrastructure perspective, but from an innovation perspective, Bitcoin mining is so under invested in. There's so much opportunity. And it's going to be a huge, huge space. Like it is by far the largest compute sector in the crypto ecosystem, and it's growing at an insane pace. And the demand for capacity on the Bitcoin network will only continue to increase. So I think it's just such a lucrative, interesting, fruitful space. And people need to start paying attention to it, especially my ilk, the venture capitalists, right? They need to stop dismissing Bitcoin mining as a space that doesn't have room for really innovative companies that can be financed through not just debt, but through equity, that have really high margins because they have zero CapEx. It's all just pure OpEx and technical build. There's a lot of businesses that can be built, and it's going to take time, but I'm hella bullish on it. I'm investing in it. And I want to invest in more of it. I think finding it is hard just because I'm not even that competent in Bitcoin mining. And I've spent 7 years talking about it, reading about it, thinking.
I think that that's one of the main things. Bitcoin mining has always been this mystified portion of Bitcoin, right? Where it is like this foundational, fundamental layer, but people haven't really dived into what it is. And we're seeing that narrative change. I think when we think of, what narrative has been out there in the world for Bitcoin mining, and we've been talking about this since, even like the Fidelity Mining Summit that we put on back in the day, there's like, the narrative is always like Bitcoin mining bad for environment, Bitcoin mining, is expensive, it's capital intensive to get into, and there's the unknowns of Bitcoin price and hash rate, right? And so those things all together, combined with how the hell do you buy a machine, right? It makes it so that people were very turn-offish from it. So I think one of the major things that I think is super important to get more investors in the space and more people looking at this is education. We need to continue to provide content for people to understand the mining ecosystem, to be able to be out there explaining things to people, because that is, I think, one of the first things that needs to happen. And you see it happen. We have conversations with people investing in Bitcoin in general, and you see them have a lot of them have the same questions, right? Around, what are the risks, what are the rewards, etc. And I think the more that we get, more content out there, quality content around Bitcoin mining, the better the world will be. And the more investors will dive into it and see it as a really investable portion of the ecosystem.
Yeah, and I think the key component here is for investors, I think it's very important to think about the weighted average cost of capital for these businesses. So I told Amanda that we would talk about Miller Modigliani 63. Says the only value of my education is knowing these esoteric things. But look, if we think about the weighted average cost of capital, right? Historically, mining businesses were financed through equity, right? And the cost of equity was anywhere from 20 to 40%. You were taking a significant amount of dilution because investors didn't really want to invest in Bitcoin mining businesses. It wasn't really until 2 years ago that we saw the introduction of asset-backed debt, right, to the mining space. And the fact that debt now exists as an option, and debt is priced very cheaply, right? Debt is typically priced anywhere from 8 to 24%, depending on the dynamics of supply and demand. But you now have this new tool in the arsenal, this new lever that can be used for financing. So the introduction of an asset-backed debt market has been absolutely transformative for the Bitcoin mining space. And when I say asset-backed debt, that's in the form of ASICs, right? So people leasing ASICs or using their ASICs as collateral to secure a loan. It's people utilizing substations and other electrical equipment in a more traditional equipment leasing model. And it's also people utilizing crypto assets that they're earning from mining, and instead of selling them, using them as collateral to obtain a cash loan to allow them to cover the OpEx of the business or to cover the cost of expansion of their mining business. So I think the introduction of debt into the space has created a whole new dynamic when it comes to financing. Mm-hmm. And then I think what's happened in the last 6 months is, as the price of Bitcoin has skyrocketed and difficulty on the Bitcoin network has dropped, Bitcoin mining profitability has gone up, which has brought down the cost of equity, because now there are many more investors who are willing to invest at very high valuations with low dilution in owning a piece of these businesses. I think part of that is also buoyed by the fact that many publicly listed miners have performed exceptionally well from a public markets perspective. And we, like Verity, I think, is helping with this as well, right? We now have the first ETF, its ticker RIGS, RIGZ, I'm an investor, love that company. They have over 10 million of AUM, right? And they've created an ETF that brings together semiconductors and mining into one vehicle, which I think is really nice for investors who want exposure, but don't necessarily want to pick single names. So I think if we look at what's happened to the weighted average cost of capital, not only has debt been introduced and fairly low cost debt, but we've also seen the cost of equity coming down. So the overall weighted average cost of capital for people building in the mining space has decreased dramatically over the last 3 years, really. And if we start to look at the implications of taxes as well, right? In the US, there are significant tax benefits to having a business that generates income by spending capital, right? You can depreciate your miners through a fixed amortization schedule. Compass and Choice, two of my portfolio companies, work together to put Bitcoin mining in an IRA as well. Like if we look at the impact of tax as well, I think we're seeing sort of this transformation happening where mining businesses are getting access to a lot more capital. That capital is much cheaper. It's available in many different sources, and there are clear tax benefits to investors who want to invest in mining. If we take all of those things together, I think we have all of the conditions for what will become just an absolute explosion in venture investing, in equity investing, in cash flow investing in the mining space. And really the only limit, again, is our imagination and our ability to conceive like just how big this could get. So
Yeah,
I'm very
no, obviously, yeah. So it's funny. I feel like we're in the stage where we were like in the institutional stage of mining, right? Over the course of the last 2 years, where like institutions were like becoming bigger and bigger in mining, right? And like that, now I think of that as like the riots, the Hut 8s, right? Those are like institutional miners. I think what we'll see as the next stage is like optimization of that, right? And that is through things like tax or, even I know that like a lot of people on Twitter don't like the idea of a solar farm attached to a Bitcoin mining site because it has more CapEx costs. But if you have a lot of capital, that then allows you to reduce your cost of electricity over time, right? So I think now we're going to see that next phase where institutions start to optimize with things like tax options, with things like, different ways to get lower, cheaper electricity, and also integration with the whole value chain and supply chain of what a miner is. So I think also very, very, very bullish. You sharing with us? You're on mute though. Meltem, you're on mute.
Let me fix that. Sorry. So I've done whole presentations on this topic. I think Bitcoin mining is going to be one of the largest sectors in the world, right? If the 2020s are about the internet, tech, and payments, I think the 2030s are going to be about energy, compute, and connectivity, and the financialization of those two sectors, because really like the digital world is predicated on access to energy because it costs a shit ton of power to run all of this really specialized hardware, and the ability to access highly specialized compute and to remit the products of that compute. So like that's what Bitcoin does in a nutshell. So if we look at like the most rare things in our world, it's GPUs and ASICs, right? Like I can't get a GPU, I can't get an ASIC today. But what I think is really interesting, right? What I said before is like, no matter how efficient you are, you can never produce more Bitcoin than the block size reward. So you have these vectors of innovation, right? Technology innovation, business model innovation, financial innovation that are evolving. These are all sectors that will have many investable businesses built in them. And then what I think is really interesting, so I'm just going to go through like really quickly, is again, people have historically conceptualized Bitcoin mining to be an asset heavy, like CapEx intensive business model. But it's not. There's this whole value chain, right, of other components of mining that are very asset light, that are very investable. But I do think the reality is this, as people start to understand the relationship between Bitcoin infrastructure in the form of mining and the security of the network and the value of the Bitcoin they own, they will start to recognize that in order to be a long-term holder of Bitcoin, you must have access to the Bitcoin network. If you do not have the ability to push your own transactions to the network, you cannot be an effective participant in the Bitcoin network. Like that is my core and fundamental belief, because at the end of the day, like surveillance and cybersecurity, right, mandate that you have the ability to control and broadcast your own transactions. Very important. So I think, again, like we're at the beginning stages of this growing awareness. And I do think if we look at what's happening with Bitcoin broadly, Bitcoin has historically been conceptualized as a financial asset. What you and I have just talked about is Bitcoin is actually compute and connectivity asset as well. And I think what I'm excited about, and the intersection that's also starting to happen, is Bitcoin as a tool to make our energy grid more robust and more resilient. It's effectively a massive load balancing tool for the energy grid, which is highly unstable at times due to these anomalies in supply and demand. And then there's this underlying layer of like cybersecurity, where Bitcoin as a communication protocol is the most secure communication protocol and secured by all of this computation. So I think Bitcoin will be relevant in terms of cybersecurity. This came up in the recent Senate banking hearing when one senator was talking about Bitcoin's ability to be a secure data storage layer for the US government, right? Which I think is really interesting. And then lastly, I think there is a world in which Bitcoin becomes part of the broader global military industrial complex for all of these reasons, because energy, compute, and the ability to secure data and information is the lifeblood of any digital nation. We no longer fight wars in physical space, we fight wars in digital space. And Bitcoin is like a digital battle axe, right? It's a digital citadel. So I think, again, it sounds crazy, but I am just so excited that we're now at the point where these things are starting to happen. Don't sleep on this as an investor. It's really important thematically to be exposed to this. This mining series you're doing is great, Amanda. The research you guys are putting out is great, but we need more. I'm hoping to bring some of that from the VC side. I'm hoping to bring some of that from the VC side, because that's what I know how to do. That's sort of my competence. But I think, again, this sector is only going to grow if we continue investing in it, and if we continue fostering creativity. And I'm very willing to invest as an angel in stuff that's not going to work, but will be interesting, right? So I think it's very important for people to be willing to put capital at risk to allow this ecosystem to flourish, and for people to have the room to create and innovate and sort of experiment and fail at things. We're going to try 10 times and learn 10 things that don't work, and then the 11th time we'll figure out what does work. But that's not a reason to dismiss Bitcoin mining altogether.
Absolutely. Well, Meltem, this was a lot of fun. Tomorrow morning at 9 a.m., we will have a Twitter Spaces where people can raise their hand and we can have a conversation with more than just me and you. So looking forward to see everyone there. And thank you so much, Meltem, for sharing your insights and thoughts on the mining ecosystem. Really appreciate it.
Yeah, thanks for letting me nerd out. I get really excited. Hopefully people who listen found it interesting. And my DMs are open on Twitter at melt_dem. Feel free to shoot me a note if there's anything I've missed, anything you think is wrong, or things that you're excited about.
Thanks, Meltem.
Thanks,
Bye.
Bye.